In the global contest for economic and geopolitical dominance, one arena where the United States remains unmatched is financial power. Despite China's rise as the world's second-largest economy and its strategic ambitions to challenge the U.S.-led global order, its financial system remains a glaring weakness. And this has profound implications for global trade, investment, and the balance of power. Let's start with the basics. The U.S. dollar is the backbone of the global financial system. It accounts for nearly 60% of global foreign exchange reserves, dominates 88% of all currency transactions, and underpins the majority of global trade. This gives the U.S. an outsized influence over the international economy, a phenomenon often called financial hegemony. But why hasn't China's renminbi, or yuan, made significant inroads to challenge this dominance? The answer lies in Beijing's own policies. Unlike the U.S. dollar, the yuan is not freely convertible. Strict capital controls and a tightly managed exchange rate have kept foreign investors at arm's length. Today, foreigners own less than 5% of China's stocks and bonds, an astonishingly low figure for an economy of its size. By comparison, foreign investors hold around 25% of U.S. financial assets. This lack of openness severely limits the yuan's appeal as an international currency. Historically, superpowers have built their influence not just through military and economic might, but also by ensuring their currencies play a central role in global trade. During Britain's empire in the 19th century, the pound sterling accounted for the majority of international trade transactions. Similarly, the U.S. dollar emerged dominant after World War II, in part because of America's open and trusted financial markets. China, on the other hand, bucks this trend. While it accounts for about 15% of global trade, only 2% of trade payments are settled in yuan. This discrepancy underscores the global reluctance to trust a currency that is tightly controlled and vulnerable to political interference. Beijing's clampdown on capital outflows, especially during times of economic uncertainty, has only reinforced perceptions that the Chinese financial system is a closed and risky environment. But there's another critical factor at play: the financialization of the global economy. Over the past 50 years, the value of financial assets has exploded to more than 4 times the size of global GDP. In this environment, open and liquid markets are crucial. The U.S. has mastered this, making its financial system the go-to destination for global capital. China, with its heavily managed and opaque markets, lags far behind. Why does this matter for the world? First, China's inability to internationalize its currency constrains its ambitions to reshape global governance and challenge the U.S.-led order. Without a trusted and widely used currency, Beijing remains dependent on the dollar-dominated system, limiting its leverage. Second, the U.S. retains a powerful geopolitical tool: its ability to weaponize the dollar. By cutting countries off from the U.S.-led financial network, Washington can exert pressure in ways no other power can. This was evident in sanctions against Iran, Russia, and even China-linked entities. For Beijing, this is a major vulnerability. While Chinese leaders have spoken of golden opportunities to expand the yuan's role, any meaningful progress would require opening its financial markets, a move fraught with risks. Capital flight, market volatility, and exposure to foreign influence are just some of the challenges Beijing would face. Yet without taking that leap, China will remain what some call an incomplete superpower. The broader takeaway here is clear: financial power is not just an economic tool, but a geopolitical weapon. The U.S. has spent decades building a system that underwrites its dominance, while China's reluctance, or inability to follow suit, keeps tea.